So we're back from Thanksgiving with a nice, boring day. It's almost like today was part of the Thanksgiving holiday too. The market didn't go anywhere. There's not a whole lot for it to go because of how mature some of these trends are. I'm going to break down the technical view of some of these mature bullish trends and what to expect because of that. And then when the market's really boring like this, is there anything to do? And that's where I kind of focus today's trade idea on what you can do in this situation like this. Let's go ahead and get started. Today is Monday, November the 27th, 2017. My name is David Settle. This is my market outlook for the day. Welcome to those that are watching for the first time. Thank you very much for coming. Welcome back to those that may have found me that used to watch me before. Subscribe to my YouTube channel. Hit that red button down below the video. Let me know that you liked the video by hitting the thumbs up. And then scroll down even further and click a comment. Anything that stood out to you from today's video, comment there. In the description is a link to my email newsletter, my daily Market Outlook email newsletter. Click on that link, subscribe there. On Twitter, follow me on Twitter for more content in addition to these videos. While you're there, at the top of my timeline, you'll see pinned today's Market Outlook tweet. Make sure you like and retweet that if you think that other people should check this out too. All right, let's take a look at the S&P 500 with the market forecast indicator here, and you see that we still have a strong bullish posture, a renewed strong bullish posture, but this bullish trend, even though we had a weak bearish posture there temporarily, is still intact. So we don't start a new 1 to 3 month waiting periods or expectations, so to speak. This is this is still part of this one. So we've been, we're almost 3 months into a strong bullish posture, a strong intermediate trend that we were probably expecting more towards 1 month, maybe 2, because market sentiment was at 70 when it started. So we've got a good, strong intermediate run that pushed us up to the highest level we've been in market sentiment since, like I said, one other time in 20 years. So very, very mature bullish posture. Mature from a long-term perspective, mature from an intermediate perspective, and of course the near-term line, now has been above 50 for what, 1, 2, 3, 4, 5, 6, 7 days, which isn't mature yet from a near-term line, but considering we're at the, we're in 3 months in, we don't expect it to last the 12 days. But of course anything can happen, and what we've got right now technically is a bullish pattern. This a strong bullish posture combined with an oversold momentum line can be used as a buying opportunity. Whether you consider that a buy the dip opportunity remains to be seen, right? So this preferred to get this buy the dip when the near term line. So you get this combination here of a strong bullish posture and an oversold momentum line. Ideally, you would like to include in that the near term line below at least below 50. Doesn't have to be below 20 because that's bearish. But at least below 50, below the lower half of the chart, something like this here, when it got that far below. That's what you want. And then you want that low point whenever it does form. So we'll get rid of this line, and the intermediate trend still going. So we'll move this up. Those are the Fibonacci retracement levels for this intermediate trend that ran. And we'll draw new Fibonacci retracements for this current near-term trend that we're in. There we go. So you can see we'd have to pull back all the way just to get a 23% Fibonacci retracement on the intermediate posture. So, but you can kind of get an idea of where we need to get to just to have a pullback, a near-term pullback that we could then use as a buy the dip opportunity. But again, any buy the dip opportunities you get right now, we're not expecting them to last very long. It doesn't mean that they can't. Doesn't mean that we can't get this kind of move or this kind of move. But like we said before, the pullbacks are getting bigger and more volatile every time we pull back. As we'll see that when we look at the VIX here in a minute. Since this mid-August run, pullbacks are getting more volatile. So so I wouldn't be surprised if the next near-term pullback got us back down eventually. See here, it got to the 62% Fibonacci retracement. The next one might get all the way down to 100%. But even then, it wouldn't be that big of a deal because it would just be a 23% Fibonacci of the overall intermediate trend. And if that's what gets the intermediate line below 50, man, then we're really, really doing well. You can see that the Russell 2000, it's a little bit more bearish, a little bit more of a pullback, the momentum line hit an extreme low point. The near-term line's in just bullish territory, but we have this kind of engulfing pattern today. We had that relatively longer upper shadow. Intermediate posture still strongly bullish, so and market sentiment still very high. So grain of salt here. But that would suggest we're probably due for that near-term pullback sooner rather than later, as the near-term line pulls back. Remember, a lot of this recent bullishness on this current near-term run, it's tax reform related, and you can see that from the relative performance of small caps. And if we start to see this extreme momentum line turn into a posture change like this one did over here, you see this one, we went sideways for a while, but that extreme low in the momentum line eventually turned into a posture change that we never did really see on the large cap indexes, but we have on the Russell. And the Russell, see, this was all tax reform related too. So we'll see, if that turns over and starts to impact some of the broader indexes. The Nasdaq Composite looks very similar to the S&P, considering that you have that bullish intermediate confirmation, but you don't have the pullback on the near-term line. You don't have a drop down to that lower half of the chart similar to the S&P. So again, looking at that candle today, would you consider that a buy the dip? Well, that one sure looked like a buy the dip, but that was only one day coming off of a low point. So now we're 7 days off of this low point. Is that considered a buy the dip, or do we need to pull back a little bit more, to get a good, even just the 6,800 here, this old high point, pull back, bounce off of it, and then run however long this current intermediate trend will take us. So looking at the long-term chart, again, we're well extended away from the 200-day moving average, and the 50-day is still way up above the 200. And again, we don't get significant pullbacks from these levels on the MACD between these two long-term moving averages. So again, any pullbacks we get is going to be short, it's going to be weak, it's just going to be muddled. So don't expect deep cuts. You might see a lot of articles talking about recession possibilities, or we're due for a pull, whatever the case is. And yes, we are very overvalued, and yes, we've been bullish for a long time, and so all that's true. But the reality is, the past precedent hasn't shown that we don't get the deeper moves, the deeper cuts, until the gap between the 50 and the 200-day moving average comes down from high levels. And you can see here, it took, to get down from 100 down to 50, took what, months. And then that just got us, that gave us one brief opportunity below the 200-day moving average, bounced right off of it. And then it took another 6 months or so for it to get to the point where it got below the 200-day moving average and stayed. So again, we're not looking for any of these kind of moves anytime soon, according to past precedent. When you look at, so I want to context that, because I might not sound very bullish. I might sound like, yes, we should get some pullbacks, but I want to make sure that you don't put me in with all the other groups that talk about either we're going up higher to the moon or we're tanking. There's more than just those two polar opposites that the market can do. And right now, yeah, we're going to the moon, and because we're so far up and so bullish, tanking isn't the other alternative right now. Grinding and going sideways, and even you can see how we even pushed higher a little bit there, but this grinding, it's going to be hard for us to maintain strong trends until we get this kind of move. Right, or even this kind of move for that matter. Even a move just to get down to the 200-day moving average, much less staying below it. Looking at the 3 green arrow chart, you can see we still got the 3 green arrows. So we're above an upward trending moving average. In fact, we're above all those upward trending moving averages, the 8 and the 17, which are included in the MACD. But again, I stress and highlight that the MACD can get above its moving average when you're grinding towards zero temporarily, and we're not done grinding towards zero. So I'm not looking for a long extended run here, because again of how because that intermediate pot trend started over here. To get a new intermediate trend going, you need some kind of pullback, some kind of breather to either this 38% Fibonacci retracement, or the 50, or even the 62 would be a deeper one. But until we get some kind of pullback in that area, then expect that these lines will still come down, and for that matter still form these divergences. And you can see these divergence low points in between correspond to at least a 23% Fibonacci retracement. So we started off strong today, and it pushed us up to a new 4-week high point. So this blue line, which represents our 4-week high, that will move up. And again, you can see we're about, what, 5 points between the 4-week high and the 4-week low. And that 4-week low is not going to change anytime soon. We've still got about another, 10 days before we even have to move that up to what would be 257.75, essentially, that low point. And that would tighten it up, quite a bit, up 2 points. So it depends upon how much we'll keep pushing up the upper band. But right now, you can see it's we're pushing. We're at the top end of the 4-week range. We're not going to turn around anytime soon when we're trading at the top end of the range. You're more worried about bigger downward moves when you're trading at the lower end of the range. And obviously, the last time we pulled back to the midpoint of the range and held it for support and bounce. So until we break into the lower half of the range and start trading towards the lower end, we're not worried about deeper pullbacks, deeper extended bearish runs anytime soon. So keep that in mind. And then you look, today's volume ended up being, 52 million, so a little bit below average. 3/4 of a point for the range. So when you look at it from this point, very, very low range, lower volume, and the average volume is dropping. Volatility continues to drop. You can see the VIX still below 10, so it didn't drop more today, but still below 10 on an absolute basis. On a relative basis, you can see it's still below 80% of VXV, the 3-month index. So that's an extreme low too. So we still have extreme low volatility. We have extreme low trading range. We have low volume. So on our up days, which today was a down day, but we're still riding an upward near-term move. It's going to be days like today where it doesn't seem like it does anything, and as we get bigger ranges, if they're extreme, then we'll have one sell-off day and we're done. But if we get ranges around 1.5 points, if we get volume in around 70 million, 75 million, so above average but not a whole lot, and above the range but not a whole lot, and the volatility bounces up, and I mentioned before, since the beginning of August, since the that middle of August time frame, every pullback has been a little bit bigger in volatility. So the next pullback you expect will probably get us up to that 15, 16 area, which we haven't seen since the beginning of August. When we had that new intermediate low point turned in, and there was your last intermediate low point. So we're getting bigger moves in volatility. There was one right there. There's another one, this next one, and then this one. So we're coming off an extreme low, and based on the patterns, we expect the next one to be a little bit bigger until we form that new intermediate low point. Alright, so we take a look at what's driving the price action today, and you can see that there wasn't a whole lot on the calendar. We did have new home sales, which continues just to be on fire. Look at the home sales. We've had a pullback in mortgage rates, and home sales have taken advantage. So doing very, very well. There's the overall economic picture, updated as of today at 57. So very, very strong positive. 49 over here on a global basis. Again, we haven't seen it in a long time this high. But other than that, nothing really changes. So we didn't have very much change in GDP. Well, we didn't have any change in GDP estimates. The Fed rate hike expectations are still on board. Still looking for December 13th. So a few weeks from now, still expecting another one by June at the very least, and higher odds for 2 more in 2018 by June than not getting any at all. So very, the odds of not getting one are dropping. So it looks like we're going to get another one in 2018. Just the economic picture is looking very, very strong and very positive, and you're seeing that starting to show up not just in sentiment in numbers, but also in numbers like this. The energy sector, this is the Dallas Fed, and this has a lot to do with the energy area. Pull back a little bit here in Dallas, so a little bit lower than expectations, and a pullback there. So definitely, we've had this kind of pullback before, and we bounce right off of that. So we'll see. One day doesn't necessarily change the trend. on that. So, but you know, essentially on a quiet day today, everything that's been moving pulled back. There's your big movers to the upside. Emerging markets, small caps, emerging markets especially, pulled back some. And you've seen that during any weakness we've had in the markets, it's been led lower by international stocks. And today, you know, it wasn't a whole lot of weakness today. But what weakness we had started off weak with international stocks. Crude oil has also been, you know, a good runner lately, but it's pulled back. So all three of these really pulled back. You see developed markets pulled back too. The dollar, which had been down, held up a little bit today. Gold doing well today. Those are the only two things that actually were up. And you can see treasuries down a little bit, but outpacing high yield. So it was a little bit of a risk-off day, a little bit of a profit-taking day on the fact that, you know, typically, we mentioned before the holiday that the day before and after Thanksgiving are typically bullish. That next Monday is typically bearish, not by a lot, as we saw today. But you know, we saw not much market moving, mature trends across multiple time frames, and so what happens? Well, the market just takes advantage and takes a breather, and when it takes a breather, things that are moving pull back, and things that have been dropping or underperforming bounce back up a little bit. Money rotates from one area to the other. So energy had a very strong week last week around that holiday. But you can see today, I mean, look at that. It's a very kind of a bearish engulfing, as bearish an engulfing pattern as you can get on the futures contract. And the other thing that kind of stands out, if you take a look, if we look at the, you know, like the MACD and the stochastics here, look at this. The three green arrows. You can see when you get a fast, quick move to a higher high like this, it leads a lot of times to divergences, and that's kind of what we're seeing here. So look for a move back down to 55 on crude oil. You know, that's where you have obviously some very strong support levels. He's already bounced off of it once, but watch for that divergence to pull us back down to 55 based on what we're seeing here, based on the fact that, you know, we've had a good strong move here for a while, and we had a strong holiday run. There was not a whole lot of volume here going on, and so now you'll expect that, you know, we'll get some kind of pullback there. And of course, you know, pullback in crude oil, especially relative to something like gold, will be more a sign of risk aversion, more so than risk appetite. And again, would correspond to potentially more of at least a near-term pullback in stocks, if not, you know, a little bit longer or weaker intermediate pullback. From a sector standpoint, not surprising that crude oil energy stocks were the worst performing asset classes. And you can see utilities was the best performing, so a little bit of a risk off there. Industrials doing well. Everything else flat. The only outliers to the downside was materials and energy. Those typically underperform when the dollar is strong. The dollar is up a little bit today along with gold. So you can see that, you know, if the dollar is expected to be stronger, which, you know, if we take a look at the chart for the dollar here, same as we saw for crude oil. Whoops, sorry, forget the symbols changed. You can see it's pulled back too and has a potential for bouncing off of some support levels here in this area, with the potential for some kind of deformed head and shoulders pattern. But the principle, the theory, the psychology behind the head and shoulders pattern would be intact, no matter how deformed the pattern looks like. And you can see the Harami with a long lower shadow, you know, would suggest bullishness in the dollar. Again, bullishness in the dollar. We've seen what sectors that will impact, but it's also typically more of a risk-off type of a move, and you can guess what sectors would benefit from that. So when the market's stuck in a grinding mode, and there's not really a whole lot to do, selling premium, there's not a whole lot of premium to sell, but it is something to do while you're just grinding. You don't have to worry about time decay eating away at you. The market's not moving much anyway. You find opportunities like a stock like this, Nucor, which is stuck in a sideways action. You can see where there's resistance, you can see where there's support. We're stuck kind of in the middle here. And so is there an opportunity to sell premium? Well, of course, if you look at the, if you sold, say, the 52.5, I got it set up down here, sold that 52.5, which has got a lower 20 delta, and then you sold the 60, which is closer to the lower 20 delta on the upper end, and then bought, protection on both sides. So bought the 62.5 call for only 16 cents, bought the 50 put for 41 cents. So there's your protection there. So you net out a credit depending upon where you get filled in. And you can see what your analyze tab looks like. So there's your break-even points at expiration, risking 187 bucks to make 63, knowing that if you break through any of these areas, these slices I put on the charts, there's the slices, there's your break-even. So if you broke through 60, or if you broke through 52.5, then we know we don't need to be in the trade anymore. So you break through 60, then you see, like today we'd have a $46 loss, and as each day passes, it's actually going to be a little bit less because the time decay brings the purple line up, for you. So that works for you when this line goes up. It works against you when it goes down. So you can see we're trying to make 63 bucks. Well, if we break 60 on the upper end, we'll be down about 50 bucks. If we break 52.5 in the lower end, we'll be down 50 bucks. So we know if you break through either one of these areas, what our loss is going to be, and that looks very attractive compared to what we're trying to make. We don't have to wait for it to get to $187, and we have a pretty decent odds, especially in the type of market we're in, that we'll stay stuck in this sideways range that the stock is trading in right now. So it's a boring trade, but we're in a boring market. And when you're in a boring market, you're not looking for big splashy returns. You're looking for boring returns because that's what the market's giving you. And here's an opportunity, a way to take advantage of a stock that's in a sideways trend, a stock that's in a boring trend itself. So we'll just kind of sit back and let time do its thing while we wait for the market to grind away. So to summarize, the market continues to ride this bullish, mature, strong bullish trend, intermediate trend, as well as market sentiment, long-term trend. So, it's mature. It doesn't mean that it has to turn over, but because it's so mature, when it does turn over, it's not going to be, we're not going to fall off a cliff anytime soon. We're going to slowly pull back. We talked about where some targets will be based on divergence patterns and other patterns there. And as we just kind of grind, the market gets really boring in those situations. Volatility is really low, so it allows us to prepare ourselves for those less boring times in the market. But while it's boring, there's not a whole lot to do in terms of like directional and speculation. You have to be really picky and choosy, and you can get burned a lot of times doing that. So today's trade example, trade idea, shows you a way to take advantage of with a boring trade idea in a boring market. As always, thank you very much for watching today. Let me know that you liked the video. Hit that thumbs up down below. Like today's market forecast tweet on Twitter. Make sure you retweet that as well. Comment. Love to hear your thoughts. Anything that stood out to you from today's video. Have a great evening, everybody. We'll see you all tomorrow.